earnings season has not been kind to big tech so far, leading to one of the worst days you have seen in the S&P 500 in many months. The S&P at the time of recording this video is down about 1.7% today. This follows Google's earnings that are sending Google stock down about 5%, as well as Tesla earnings that happened last night as well, down about 11% today. This is causing a sympathy move with all of your other big tech. Nvidia is down about 5%, Microsoft down 3%, Amazon down 2.5%, Meta down 4%, even Apple is down about 3.3% today. But what you might find very interesting is the Russell 2000 is massively outperforming today relative to the NASDAQ and relative to the S&P. IWM is only down 1/3%, which is actually just outright impressive. Funstrat on X says technicals confirm we're in the summer of small caps. IWM relative to the equal weighted S&P 500 RSP at 169 has broken out of its 2-year consolidation. This is quite constructive and bodes well for small cap outperformance, technically speaking. This is from Mark Newton over at Funstrat. But what actually caught my attention was this post that Tom Lee shared multiple times with different things to say on his X account. The post is from Dudley that says the Fed should cut, preferably at next week's policy making meeting, although it might already be too late to fend off a recession. Tom Lee says Fed cuts in the near term equals support for the summer of small caps. But he also says data dependence is too backwards looking. The Fed cuts sooner makes sense. So Tom Lee is basically saying the Fed needs to start cutting rates now. Now, the guy that actually said the Fed needs to cut rates now is the former New York Fed president, Bill Dudley, that has shifted from advocating for higher interest rates to urge the Federal Reserve to cut rates immediately, citing changing economic data and the risk of a recession if action is delayed until September. This change in stance is part of a broader discussion among economists and market observers, with some suggesting that the Fed might be influenced by market pressures to act sooner rather than later. He also goes on to say that, quote, I've long been in the higher for longer camp, but facts have changed, so I've changed my mind. The Fed should cut, preferably at next week's policy making meeting. And this is actually being talked about by everyone. Even Nick Timiraos says Heidzi's predecessor, former New York Fed President Bill Dudley, flips from higher for longer hawk to cut now dove. And when Nick Timiraos tweets about something, that gets the Fed's attention. Currently, the odds of a July 31st Fed rate cut only sit at about 5.2%. The odds of a continued pause through July 31st next week is 94.8%. But with these calls, the Fed should be cutting rates now. I think the Fed already understands this. There could be a higher than 5% chance we do get a cut coming next week. For the Fed funds futures market, specifically the contract expiring on December 18th, 2024, the last Fed meeting of this year, markets are pricing in a 54.0% probability of 3 cuts by December. So markets are currently expecting a cut September, a cut November, and a cut in December. There's only a 37.1% chance of 2 cuts by December 18th. And there's actually a 6% chance of 4 cuts by December. It looks like the rotation trade is starting to garner even more attention. Take a listen to this 2-minute long clip on CNBC that's titled, "There are other places now to invest besides just big tech." This is from Advisors Capital's Joanne Feeney.
With her view on the market and some top picks, Joanne Feeney, portfolio partner and a portfolio manager at Advisors Capital Management. The great rotation, it's on, it's off. Is it on, Joanne?
Hey, good morning, Joe. No, I mean, people are looking for other places to find some appreciation potential after the big run for the big tech stocks. And given that the economy has held up better than expected, looks like rate cuts now far more likely than they were a couple of months ago. Investors are finding more comfort in the recognition that lower rates are going to help biotech, they're going to help healthcare more generally, they're going to help industrials. So there are other places now to invest besides just the big tech companies. And in addition, of course, we're seeing now some improvement in some of the cyclical areas, not just in consumer, but also in tech. I mean, look at Seagate's results. Really interesting signal as to the return of enterprise and cloud spending. Texas Instruments signaling improvement coming in automotive. That's a very good sign. Inventories haven't been worked down already in China. So we're getting some good information out of these earnings reports that we think are going to be far more impactful on where the markets go than even the Fed decision, because I think that's pretty much baked in at this point.
And no one can predict the future. We've seen quite a few reports so far. What are you going to think we're going to see for the rest of the reporting season? Where do we find the best value?
Oh, Joe, one of the things we're concerned about is really what the outlooks are going to be for different companies in the consumer space, because we see earnings now as separating the wheat from the chaff. It's not going to be an industry goes this way or that way. It's really going to be company specific. I mean, look at the consumer space. We had reports out of Polaris, for example, highly discretionary spending category, and you compare that to other areas of consumer that are doing well. So consumers clearly facing struggles in their pocketbooks, trying to economize, cutting out those really high expensive outdoor toys, and going and sticking with more of the essentials and, some of the more affordable ways to get entertainment. So it's going to be company by company. We still like the off-price retail, like a TJ Maxx. We still like places where demand is relatively inelastic. People need places to live. We still favor Lennar over the long term. Home Depot, because you're going to need to keep your house maintained. But we also, again, still like some areas of tech, whether it's AI related like NVIDIA and Broadcom, or the new PC cycle that we think is coming, which we think will benefit AMD and Qualcomm.
Right.
So there's definitely starting to be more calls for a broader rotation out of big tech into other stocks. Stocks that potentially benefit from the Fed cutting rates, which could spark an even larger rally in the Russell 2000, something Tom Lee has been predicting now for months and has really doubled down on this in recent weeks. Now, as I mentioned previously, Google reported earnings last night, as well as Tesla. Now, Google's numbers actually beat expectations across the board, or met expectations at least, besides for YouTube ad revenue. Go figure, right? Now, these were not bad earnings, but they were not impressive enough. Wall Street was baking in much better than expected numbers than we actually got. This is a risk that I have been talking about for weeks now. And I think if you still look at other big tech names, even though they're down today, they're still pricing in too high of expectations. The expectations are just still too high for Apple and Microsoft and Nvidia. Likely you're still in for more upsets when these other companies start to report earnings over the next couple of weeks. Whereas things are going to be getting better in the Russell 2000. We're expecting faster EPS growth in the Russell than the S&P. Now, the biggest potential risk to our markets from that standpoint, especially to the Russell, is what happens with the economy. If the economy gets worse and things start to go downhill, then the Russell will get outsizably affected by that. But so far, things look okay. This morning, we had good trades balance that came in at negative 94.8 billion. The estimate was 102 billion, so that was a little bit better than expected. Retail inventories, excluding autos, month over month came in at positive 0.2%. Not great. We were expecting negative 0.1%, but not terrible also. Wholesale inventories month over month came in line with estimates at 0.2%. And these inventory numbers, the good trades balance, that affects your GDP estimates. And coming tomorrow, we're going to get a new GDP estimate. So could be important. Now, today, this morning at about 9:45 in the morning, you did have the Bank of Canada's interest rate decision. They did decide to cut rates again from 4.75% down to 4.5%, even though their last month's CPI report came in hotter than expected. We also did get S&P Global Composite PMI Flash that came in at 55. We were expecting 54.7. S&P Global Manufacturing PMI Flash came in at 49.5. We were expecting 51.8. S&P Global Services PMI came in at 56. We were expecting 55. 5. So these numbers came in better than expected across the board. New home sales came in at 0.617 million. We were expecting 0.64 million, so that was a miss there. New home sales month over month were expected to rise 3.5%. They declined 0.6%. The previous month, you actually seen a decline of negative 14.9%. So on a month over month basis, only expecting 3.5% was really not great because last month was so negative, but you were actually revised lower by over 3% negative, and then you still came in negative. The housing market is terrible, ladies and gentlemen. And some people might be looking at this and saying, if the housing market's going to be this bad for this long now, at what point does that start to affect the economy? And I don't have that answer, but let me know what you think down below in the comment section. CNN's fear and greed indicator today is now at 43, which is a sharp drop from yesterday's neutral 55. So definitely seeing some of this selling being reflected in your sentiment gauges. Market momentum is neutral. Stock price strength is neutral. Stock price breadth is fear. Put and call options is neutral. Market volatility, extreme fear. Safe haven demand is extreme fear. Junk bond demand, extreme greed. The percent of stocks currently trading above their 50-day moving average is up to 67.11%, which is much better than where we were over the last couple of weeks, hitting a low of 35%. But this actually means about 2.1% of all stocks today are breaking below their 50-day moving average. So you do have a fair bit of stocks that are in downtrends today. And your latest AI investor sentiment survey shows bullish investors at 52.7%, neutral investors at 23.8%, and bearish investors at 23.4%. 10-year treasury yields are down almost 1 basis point today to 4.23%. Your Atlanta Fed GDP Now tracker is now estimating 2.6% GDP for Q2, down from 2.7% yesterday based on the data that we got this morning. We'll have more earnings today and after hours with Chipotle, Ford, ServiceNow, IBM, Viking Therapeutics, Las Vegas Sands, Newmont, Saliska, Whirlpool, and Waste Management. Tomorrow morning, we have American Airlines, AbbVie, Hasbro, Honeywell, RTX, Southwest, Keurig Dr. Pepper, AstraZeneca, and Valero. Thursday after hours, Dexcom, Skechers, Texas Roadhouse, Deckers Brands, Boston Beer, Juniper, LendingTree, Appfolio, and Noi. And then Friday pre-market, you have Bristol Myers Squibb, 3M, Charter, Centene, Colgate, and T. Rowe Price. You can also see the VIX today is up almost 17%, now to 17.22, which is a very large spike for any single day. Just goes to show that Wall Street is kind of rushing into some put protection at this point. It's like, for whatever reason, people are shocked that these earnings did not impress investors after the rallies that we've seen over the past 3 months. This was almost a guarantee. And that's why I was stressing this in many videos now. Like after a 30-40% rally, is Google really going to impress investors? Is that going to be enough to send Google stock higher, even if earnings are great across the board? Probably not. Now, for the S&P 500, you are coming back down to your 50-day moving average. That is at $540 for your SPY. Now, this is the first level I would expect more support. Then you have your 100-day moving average at 525. I think we're going down to 525 at the bare minimum. So keep that in mind. I think 520 would be another good level of support as well. Undershoot that 100-day moving average a little bit or overshoot that a little bit and then find some support around there. That would be a good little correction. If things were to get worse, political volatility ramps up or the economy gets worse, then you can expect a test of this 200-day moving average at $493 per share. So let me know what you think about all of this information down below in the comment section. Hit the like button as well as subscribe to the channel. You guys have a fantastic rest of your day, and I will see you in the next one.